Today's show, we're talking about tax and legal strategies, wealth building, entrepreneurship, and this world can be confusing. There's a lot of questions. Lawyers are expensive. This is why we do this podcast. We want to get you the answers. So Stephanie B asks, I've started a YouTube channel and I'm wondering if I can write off expenses incurred for the business that also can be used personally. Example, garden equipment used for the video, but since it's home base, can we use the equipment in the future? Am I able to take 100% of the write-off or do I need to do a percentage? Any of you that have a YouTube channel, as long as it is a business that you earn income from. Now, maybe you're getting revenue from YouTube. That's one of the nice things about YouTube. That's maybe different than a podcast. You could be getting revenue directly from YouTube, which is taxable and which can count as a business in and of itself. Maybe you've got some affiliate income from selling gardening tools or equipment, or you got a training class or a course or a retreat, whatever you're offering there that creates income, that is a business. I'm just saying you've got to have income here before you can have any expenses that can qualify here. Now, yes, if you have gardening equipment that you're using, I think it's okay to have some reasonable personal use of it. Now, let's get to the real issue if you were under audit here on these items that you're buying was the reason you purchased this for business? If you're like, no, I really just happen to use it in the video, you might have to take a percentage there of personal use and business use. But I think if you're actually using this stuff in your videos, particularly if you're promoting these types of products and things like that and you're buying, I'd absolutely be taking them as a deduction. But I wouldn't have some it's in one video type use and you really have a massive garden in your backyard.
My wife's grandparents recently passed away. They held their house in a trust. She is entitled to 12.5% of the trust as a beneficiary. I believe from what I read in the trust, the only asset is the house in the trust. And then the question is, how is the money taxed?
The first thing is grandma did something right. She had the property in a trust. It's going to be nice about this. It's going to pass without probate. Trustee of the trust. Maybe that's one of the kids that's, taking over as trustee here is going to be able to sell the house. Now, when the house sells, the cool thing about this, there will be no tax.
At this juncture,
we're presuming you're going to go sell the house and put it up for sale. So even though mom may have bought that property for $100,000 and now it's worth $500,000, that whole $400,000 of gain is going to get wiped out, not taxable at all. You get what's called a step up in basis. So when you guys sell the property, they're going to look at date of death. The property's worth $500K and then you sell within the next 3 to 6 months after she passes, you're likely going to have no gain. And then there's no inheritance tax. There's no estate tax. Presumably you're under a 12 million estate here. Otherwise you could have estate tax. Don't stress about the tax. I think you're good here. And I think as a beneficiary under the trust, you're entitled to know what the trust owns. So it might only reference the house in the trust documents itself. All these other assets typically are supposed to fall into someone's trust. So for example, did she list the trust as the beneficiary on the life insurance policy, on her bank account, on grandma's IRA or 401k, on her savings account? So there could be all these other assets that are supposed to be flowing into the trust. And you don't know that. Like even us, when we draft estate plans for our clients, unless the client has a specific provision about that asset going to someone instead of just everyone, getting 1/8 percentage share, they're 12.5%, 1/9, whatever that is. But we're not going to say and identify all the assets in the trust itself. So that's the job of the trustee to go find out. And as a beneficiary to grandma's trust, you're entitled to that information to know what it is. In 2022, I invested in a currency trading investment opportunity, which turned out to be a scam. Too bad it wasn't Bitcoin in 2012. Oof. When the company notified us that the investment money was gone and could only be partially returned, we withdrew our funds and showed a short-term capital loss of $30,000 in 2012. To our surprise and delight, in 2023, 11 years later, that's the American court system, took a decade to get a good answer on this case, we received a lawsuit settlement check for $16,000 and a 1099 misform. Additional tidbits. From 2012 to 2023, we continue to have short-term and long-term capital loss carryforwards, for which we can only claim a $3K loss per year. I'm hoping the $16K settlement money can be shown as a long-term capital gain. Here's the thing. What is the true nature of that money? I think if you got a 1099 miss, which a lot of people are going to think that's ordinary income, right? But why did you get that settlement? That's returning what money you lost, your basis in an investment. That wasn't compensation for doing anything. That wasn't pain and suffering. So one of the things when you get a settlement, if you, let's say you're in a car accident and you get a settlement for $100,000 and it's like, it's for pain and suffering. Pain and suffering is not taxable. Let me say that.
Yeah.
Pain and suffering is not taxable. Lost wages is, and you have to get into an analysis. If I got that $100,000 settlement from a car accident, how much was attributable to me losing work? How much was attributable to my pain and suffering, and those different categories. So that's, I think, why you got the 1099 miss, is that's just what happens on settlements. But I would still look at what's the true nature of the income. Here, sure this was a recovery of dollars lost in an investment.
So it can be very complicated on the three categories of actual damages, emotional distress, and punitive. So if you're getting a settlement, you really need to consult with a tax advisor that understands this settlement aspect of injury. And IRS has all sorts of stuff on this if you start looking at settlements and judgments.
Can an S corporation purchase a residential property for personal employee use? I want to have a home away from home for myself and my employees. We do an employee retreat at a minimum once a year, and I'd also like to offer the home as a benefit for a limited number of weeks per year per employee. I would also be using the home as my home office space while I was there. However, my business, an insurance agent, has nothing to do with real estate or rentals. You could buy this as a second home. I wouldn't buy it in your S corp, by the way. We just set this up in a separate LLC, and you could maybe use the Augusta rule for the week you use it as a retreat for all of your team, where you're actually renting it to your own business and getting to take that in as a non-taxable income. Look up the Augusta rule. There's some other stuff and content we've done on that. But this concept of using it yourself personally, letting your employees use it personally. Do you know if you let your employees use this, you actually have to tax the value of it to them if you're going to try and write it off? That's additional compensation. Just because they're an employee of yours doesn't mean, oh, this is an expense for you. Oh, it is an expense for you. Only if you make it taxable to them. Just saying, hey, I'll let my employees use it. This is business. This is all a write-off for business. Are they using it for business? Are they meeting customers there? Are they having business meetings? Are they just using it for their family vacation or their own family retreat or personal use? So it's still going to get down to what is the actual use of the property? Is it business use or is it personal use?
Of you or your employees, yeah.
Of you or, yeah. I'm really struggling to figure out what to do to protect my farm. My question is, how do I maintain the veil between the farm and the property? Do I have to do anything, or do I have to show some sort of transaction relationship? Is it as simple as getting set up as some rental agreement between the farm and me? If so, not how I capture this on Schedule F. Ooh, interesting, okay, for farms. All income currently being reported on my personal tax return as I am running as a sole proprietorship. Just know farming is a little unique, and that Schedule F is a little unique. You know, some people might be thinking, should I use an S corp or not? Anybody in the agricultural space or a farm, it depends. That's where you do need to get the tax console. I think for planning of sale of this as a business, let's separate the home from the actual property where there's income being produced. It's going to be simpler from a tax standpoint and also from a later standpoint when you want to sell this operation. But I'd also just recommend getting a consult with one of the tax lawyers. There's some in our firm that are familiar with the farming operations and have worked with a lot of clients in the farming space. You have a lot of actually unique write-offs and stuff that not a lot of businesses have.
I would like to know how to avoid paying so much taxes on the property and how to go about putting this property and my current house in a trust. Not sure when I receive the inheritance, but should be coming up. I'm trying to get all my ducks in order before everything happens.
Don't stress about the taxes right now. I don't know how substantial the rest of this is, but then you're going to need your own trifecta, like just talked about recently too, to separate this out. What are you going to use with that money? You're going to have a lot of stuff's going to be showing up on your asset side where you already have your home. You're going to have this other property that could be rental. Maybe you're going to sell it. We don't know. You have all these other substantial things you're inheriting. How are you then going to deploy that money into an investment strategy? So I think the nice thing is you've got some legal hoops to jump through to get here, but these are good things, right? These are the good problems to have, and we can help you get that structured properly so you're efficient moving forward, protected. The second thing I would say is you need to get your own estate plan going, and I love that part of this here. And we set up thousands of estate plans a year. We need to have estate plans. I was just at a funeral a couple weeks ago. You know, we are not invincible. We are going to pass on one day. I'm actually updating my own estate plan right now. I met with my wife about it last week. We're just going through all the different provisions. We got the yours, mine, and ours stuff. But just take the time to make a plan. For those of you that have a trust, passing down assets, you're making it so much more simpler for your loved ones to carry on, to know what your wishes are, to have it organized and outside of court and outside of probate. So just a couple quick tidbits there on estate planning and what to do.
Would a small business with a small number of full-time or part-time employees ever benefit from a PEO? Now, that's a professional employment organization. It's kind of like setting up an entity to hire employees and lease them back to your business. And by doing that, this PEO might have economies of scale to get better health insurance plans, better manage a group 401k or some benefits of some sort, a cafeteria plan. And so medium or larger businesses with multiple locations may do a PEO.
I would just say do this for business reasons more than I would say do it for tax or benefit reasons. I think the clients I've seen used it over the years, are kind of like these smaller businesses. You have more than 10 employees, but you're not like at 100. So you're like a good little operation where you have enough employees where can be valuable to you, but you don't have enough where you want a whole HR team. But also I see it more with businesses that have more turnover, more manufacturing or restaurants or things like that, where it could be higher turnover and you just don't want to have to deal with all the hiring and firing and onboarding and all that. The bottom line is you still have the obligation to train. These are still your employees. You have the obligations to offer good benefits to them. And that business, that PEO is trying to make money too. So there's a cost to that you're going to pay, plus the wages you're going to have to pay the employee. So I just myself, as I looked at this, a long time ago, it was like, it just didn't make sense because there's more cost to it. It's not a strategy we typically recommend clients use. Let me just say that out of the box. Can an S Corp with no employees that has a solo 401k own another percentage of an S Corp that has full-time employees or employees without putting its solo K status in jeopardy? Solo 401ks are awesome 401k plans for anyone who's self-employed with no employees. Now, if you have that business that is a legitimate S corporation and you have no employees, great, go do a solo 401k. But if you have employees and other companies that you also own, this is where it starts getting tricky. And even amongst our lawyers, we all debate this and go through scenarios because it's super complicated. I'll give you the general rule of thumb. I would say if you own that other S corporation or business, doesn't matter the entity type, more than 50% or more, you're not gonna be able to execute on this. There might be an exception to that if this is a very large business, but as a rule of thumb, if you have another business with other employees that you own 50% or more of, you're not gonna be able to do a solo K in a company where you have no employees. And we also need to know, are these businesses separate? Do these businesses relate to each other? Are they have similar customers? Are these companies transacting between each other? Do they share employees? Or is this really like you've got the dentist over here with their practice and you got the spouse who has a real estate brokerage entity, or there's a real estate professional or something like that.
I hope you found value in that video and took something away from there that can help you on your wealth building journey. Make sure you're subscribed though to the channel because I got tons of information I want to share with you to make it easier, faster to build wealth. We'll see you next time.